As we close out a week that's seen major volatility once again within financial markets centered upon Nvidia earnings. They beat, but the rebound certainly didn't last. Also, the likes of the jobs report coming out on Thursday, where we saw strength in terms of the headline payrolls number, weakness in terms of the previous revision, and a rise in terms of unemployment, alongside FOMC minutes that pointed towards a likely pause in December. What do we have for the week ahead? Well, we still have plenty to sink our teeth into, most notably because the US has a whole raft of data that gets released in the wake of the end of the shutdown. That, alongside the UK budget and the RBNZ interest rate decision, make for another interesting week ahead. So first and foremost, let's just jump into the outlook for the big ticket items according to Trading Economics, as we always do. So IFO business climate out of Germany on Monday, the PPI number coming out of the US alongside retail sales on Tuesday. Then we have a whole raft of data points from the US on Wednesday. Core durable goods, GDP, core PCE, personal income, personal spending. What's interesting here is that we don't just see 1 month's worth of data. For many of these releases, we have 2 months worth of data because we see both the September and October numbers coming out. Of course, that's particularly notable for the core PCE price index. Remember, we've just seen the FOMC interest rate decision. So we've just seen the FOMC minutes. And within those minutes, we saw that they said that many members believe that the current economic conditions mean that it's prudent for them to keep rates steady for the December meeting. Well, in my mind, I think this is because many are fearing the inflation side of the dynamic, because essentially they have a dual mandate. It's on the jobs market and the inflation side. They, of course, cut last time around, which means they might now think, well, look, we've already taken some steps to try and aid things on the jobs market. But what if the inflation issue starts to rear its head once again? So maybe it makes sense to take a little bit more of a cautious approach. Well, if we do see inflation largely capped when we see these core PCE price index measures, it does provide the basis for a potential shift in December. Anyway, we're getting a little bit ahead of ourselves. We'll be talking about the US at the beginning anyway, so we can cover that in a sec. So GfK consumer climate, then inflation data coming out of the Eurozone, and GDP from Canada. So like I said, the US data releases are going to be thick and fast over the course of the coming week, most notably centering around Tuesday and Wednesday. The weekly ADP payrolls figure on Tuesday, alongside the likes of the core PC price index, I think are going to be the really key ones. Core PC price index expected to come in at 0.1 and 0.2. If we did see that, that by and large points towards a inflation picture that seems to be under control. Now, if you look at the trajectory of inflation at the moment, they've all kind of converged around the sort of mid to high 3% kind of area. Certainly not under control. And, you know, ultimately, when you're looking here in terms of that sort of outlook as things stand, you can see that by and large, when we're looking at the sort of hefty monthly figures for the core PC price index, we can see that generally they came around January and February. So it might take us waiting until the end of Q1 for us to see inflation largely under control. If you look at the 6-month annualized figure, you can see what's the pace of inflation once we get that January and February out the way. Well, as it stands, the core PC price index would be on track for a move to 2.5%. Of course, if we did see a 0.2 and a 0.1 to add to that, then it would likely drive down that metric even further towards that 2% target. So certainly, I think there'd be emboldened calls for action from the FOMC in December if we do see inflation under control, and in particular, keep an eye out on those monthly metrics, because that really tells you about what's happening over the near term. In terms of market expectations, this has actually shifted a little bit since I screenshotted it. Essentially, 56%, I think that's more like 65 now, actually. So we did see an initial reaction after the jobs report, and then we've seen that move a little bit back in the first place. So the base case scenario right now is for a pause in December. But ultimately, the thing here is that markets are expecting us to get to 3% by the midpoint of next year. So whether we see the rate cut in December, whether we see it coming in January, ultimately the end game appears to be the same kind of place, and it's not really shifting, which is notable because bear in mind in May, Donald Trump gets to appoint a new head for the new governor for the Federal Reserve. So that would point towards a possible dovish shift if he or she gets to do Donald Trump's bidding. He's certainly not going to be happy with rates at 3%. So that's where the shift is likely to change, or where a notable shift could change. Whether we see a rate cut in December, whether we see it in January, should kind of be here or there. But I don't necessarily think the markets see it that way. I think markets do care, and they really want to see the rate cuts sooner rather than later. Now, in terms of, let's just jump into the charts. Here we go. So first and foremost, I wanted to bring up a index because, you know, the moves that we're seeing at the moment are just too dramatic to miss out on looking at exactly how this is shaping up. So this is the index for the Dow Jones Industrial Average. And as we can see here, let's just squish it in. As we can see here, very clearly a bullish trend in play. But we've seen this period of downside. In the past, when we see periods of weakness, it generally takes the form of sort of one bad week, and then we see the bulls back in play. But, you know, this has been a bit of a period. It's a 3-week period. Now, I'm recording this on Friday, and I'm aware that if you look at price action over the course of each Friday, it generally has been pretty good. So let's look at, okay, this is for the Dow. I'm thinking more about the NASDAQ, but nonetheless, you can see that the initial significant declines got brought up here Friday here. So that was a nice day. So you can see that significant losses recovered the entire thing and ended up in the green. So the past 2 Fridays, actually, we have recovered quite a lot of the losses. So I'll be interested to see exactly how we shape up today as we close out the week. You can see here as it stands, we are actually seeing a little bit of a rebound. But really, you know, of course, we've been seeing all this price action over the course of the week and big question marks around NVIDIA in particular. And ultimately, you know, that tech sell-off, it's not necessarily an issue that I don't think it's going to go away. I don't think that the problems that many people are worrying about are current problems. Many people are worrying about things like energy supply down the line and whether the current projections in terms of future earnings make sense given the high probability that they won't actually be able to find the energy to actually run these data centers, things like that, right? So they are relevant now because we're talking about current day valuations and whether they're realistic, but some of them are kind of issues that I don't necessarily know that we should see the massive collapse in the market right now because of it. Do you buy the dip is the big question mark here. And, you know, I would say certainly if we break the 45172, that's the thing that really would start to point towards a big, wider sell-off coming into play. We have seen a very significant decline here, despite the fact that earnings have been very good so far. So we're down 5% so far. Earnings season largely done now. And it has been a very strong earnings season, as highlighted by the fact that NVIDIA came out with such a strong release, 62% gains in terms of revenues for the year on year. So, you know, I think we have moved beyond this 76.4 fib now. So that does raise questions. We had respected it for a couple of days and rebounded from that level. But then we saw that sharp decline, you know, that initial gap open recovery and then that sell off. You know, it was pretty brutal on Thursday, quite frankly. So it's a dangerous one, quite frankly. It's not necessarily something that I'm saying, oh, buy the dip, because we know that we're going to rally from here. My caution here is that Michael Berry, who I think is central to all of this, because many people had fears, but you've got this legendary investor saying this whole thing is fraud. I've got massive shorts out on these companies and I'm going to prove to you why. Well, he's got an announcement being made on the 25th, he says, at the latest. So that I think is going to be a major hurdle up ahead. And I think there could be significant jitters until we see that cleared out, and hopefully not necessarily too much of it. But certainly if he comes out with something that spooks the markets once again, that could drive that near-term downside. But yeah, so we've broken through the 76.4 fib. I think certainly if we're going to start coming back into a more positive mindset, yesterday's high of 468.60 would be a key level to watch out for it to potentially break, for the bulls to come back into play. Then we've got the budget out of the UK. By and large, a pretty boring week apart from that. But the budget really will be absolutely crucial going forward. Of course, we've seen a lot of chopping and changing for the UK government in terms of announcing what they're going to do. I mean, obviously they haven't announced it, but they have leaked a number of different things. So we've got a good idea of the kind of things that could come to fruition. But it appears to be the case that the income tax hike isn't going to happen. That being said, whilst they will be proud to say that that means that they've kept their pre-election promise of not taxing working people, in actual fact, it's very likely that they're going to freeze the tax bands, which means that essentially you have this thing called fiscal drag, where people just get dragged into the different tax brackets because their wage goes up, but the tax bracket doesn't move alongside their wage. So people will be paying higher wages, higher taxes, despite the fact that we won't see that rise in terms of income tax. In terms of where we should be looking and what the implications of the plethora of measures will be, well, I thought it interesting for us to look at this from the perspective of the fixed income space. So what I've got here is, here we go. So what I've got here is the relationship between the 2 years and the 30 years. 30-year relationship is more going to be about the market perception of how stable the country is down the line. The 2 year is going to be more a perception of where interest rates are going to be over the near term and the Federal Reserve versus the Bank of England. So I've got the ratio between the UK 2 year and the US 2 year, the UK 30 year and the US 30 year, and then cable, which is the candlesticks underneath. What I would say is that we've actually seen a rebound in the 30 year that hasn't necessarily happened to the same degree in the 2 year. So you can see it's very close correlation. And then we've seen that sort of divergence recently as price action has remained relatively low. That to me points towards people caring more about the near-term short end of the curve, which means people care more about where interest rates are going to be going rather than question marks around long-term stability that might emerge amongst this budget. So essentially that means look at this budget through the prism and forthcoming data out of the US through the prism of how it might impact inflation and how it might impact interest rates. And notably, last time around for the spring budget, we actually saw a significant spike in terms of inflation off the back of that, partly off the back of that. And so we have heard this time around that they want to keep prices for households lower. So keep an eye out for any announcements in terms of driving down energy costs and things like that. Because if they do manage to keep inflation, keep a lid on inflation, it points towards a possibility of further downside for the pound coming into a period of time where we're expecting to see the Bank of England cut interest rates. So if you look in terms of the, here we go. So if we look in terms of the sort of daily time frame here, we've got this double top formation. We broke through the neckline 131.4 essentially, and now we've rebounded, formed a intraday double top formation, and now we're sort of consolidating a bit, but essentially I just see that rally as a likely precursor to the bears coming back into play once again. So if we break through the 132 level, then yeah, things start to look a little bit more like we're going to see a more protracted rebound into play. But because of this double top formation, I think there's a good chance that we see the bears coming back into play once again for cable. And finally, we've got the latest RBNZ interest rate decision coming out on Wednesday, or it depends where you are. Tuesday night, Wednesday morning. Markets expect a 25 basis point cut. Remember, we saw a 50 basis point cut last time around. And certainly you're looking at a economy that's been struggling a bit of late. Certainly there's question marks around why we're seeing so many people moving away from New Zealand, many moving to Australia, people saying there's not enough jobs. In terms of inflation, you can see here the latest RBNZ surveys have seen that businesses, economists, forecasters expect inflation in both the 1 year and the 2 year to remain very steady, just above the 2% mark. And then when you're looking at the household perception, the median is at 3%. The mean is at 4.3, but it's been coming down. So there's a feeling that inflation is largely under control, certainly anchored expectations. And then you can see the third line from the top, unemployment in New Zealand on the rise. And so they will likely feel the need to act once again. In terms of market expectations, overwhelmingly, there is a view that they will cut. It's just by how much, a 3% chance, outside chance of another 50 basis point cut. And you can see further out, markets do think there could be another cut later on next year. So how do we play it? Well, notably, we could find ourselves in a similar position to what's been happening in terms of the Swiss franc. The Swissy has been a big outperformer of late. And this is something that I highlighted a while back, that when you see these central banks sort of front loading their cuts, a lot of the time the movements you'll see in terms of the FX markets will be relative yields within the two countries, essentially. So we can see here in terms of the New Zealand dollar against the Swiss franc, that essentially you're looking at a pair where the Swissy's already sort of done its damage. The Swiss National Bank have essentially already cut, and now they're just keeping rates steady. Whereas you're seeing an RBNZ that continues to cut, and we see weakness as a result. So we could get into a position after this cut that if they lay out a pathway and say they don't think they're going to cut anymore, then possibly we see the New Zealand dollar coming into strength against currencies that still have plenty of easing to do. But we're not there quite yet. And that points towards the current sort of rebounds, current recovery that's been playing out at the moment as being a likely short-term phenomenon. Trendline resistance up ahead. I think watch out for intraday signs if we do see a move back down towards the downside, a move back down towards your sort of 448 mark. So near-term gains, I think, are likely to be fleeting in nature, with a rise through 462 required to signal an end of the downtrend that's dominated over the past 6 months for the New Zealand dollar against the Swiss franc. I hope that's been useful. Make sure to like, subscribe, and follow for more. Other than that, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead.